You are already on.
The oldest version of
Is it and you, that's for Mexico, eh?
Peru, actually.
That's for Mexico? For Peru. Ah. Okay, so good morning. So exam question next Friday. Who was the winner of the Amsterdam Gold Race? Italian. Carpaccio. No.
Carpaccio.
Who was the winner of, you know, the Amsterdam Gold Race? Where? You were in Maastricht, huh? There was nothing happening in Maastricht yesterday? Huh? In the room? Making a paper? Ah.
Who was that? I thought it was Italian, seriously.
No, it's from Poland.
Yeah?
Yeah, it's the world champion.
Oh, wow.
Look on internet.
I did on Friday.
Ah. Okay, so where are we? So we finished the introduction. Okay. Again, the whole story of introduction, it's especially presentation on governance, risks, and so on. I'm not going to repeat it, but the main message is not more, but other regulation, and you need to introduce in companies not just management control, but management control for top management, behavioral risks included. Okay. So yes.
What is the difference between external governance risk management and behavioral risk management? Because for me, this irrationality or confidence.
I fully agree. So behavioral risk management, it's part of managing the internal governance risk. You see, so there are not two different things. You have governance first. You have external governance. Okay, that has more to do with efficiency, but then you have the internal governance problems. But the internal governance problems it has to do with behavioral risks. Okay, so behavioral risks, it's part of the internal governance problem. Okay, okay, so and then we started with 2, and that's the topic of financial risk management. First of all, we discussed the framework, the different risks and so on. Okay. Again, if you go to your book, you have different chapters on transaction risk and so on. But again, just from those chapters, just take the items that we discussed in class. But normally, again, if everything is clear, if everything is clear based on the discussions here, okay, you don't need you don't need to go to your book. In fact, okay. So remember also spot borrowing, money market hedge, and so on. Then the conclusion of the framework was that if you go to the management of the risks, that a very important group of techniques are the so-called derivatives, okay? And then the B, it was what are now the definitions of the building blocks in the world of derivatives, okay? Just the general definitions about swaps, okay? And we did the case on interest rate swaps, and from interest rate swaps I tried to convince you that if you go to currency rate swaps, that's the same story. You just have then interest payments in different currencies. So the story about swaps. Then the story about futures and forwards. In general, futures listed, forwards forwards over the counter. Okay. Again, if it's for financial risk management, you expect to see futures or forwards. So you expect to see forwards, and because remember futures are standardized, then you are over or under hedged and so on. Okay? So futures forwards. Remember, forward, it means you have you have the obligation, okay, to buy or sell something at a future date, okay, but at the price fixed today. The price that you fix today in a forward is always the spot rate. No? Let's kill him. No, not the spot rate, the forward rate. And remember, we did in class, how do you calculate the forward currency rate? The forward currency rate is based on, first of all, yeah, no free lunch, except for her. So the forward rate is based on, yeah, but more. So what do you need to get from me in order to calculate the forward currency rate? First of all, you need to have the spot rate today. Okay, you need to have the spot rate and the two interest rates. Okay, and again, and the reason why there is a difference between the forward rate today and the spot rate today, it's because of the interest differential. Okay, if there is no difference between the level of the interest rate of the two countries, then the forward rate is going to be the same as the spot rate. Remember, so so it's not so a forward rate. It's not something that we can discuss. Okay, so no, it is it's a result of current market rates, interest rates, and the spot rate. Okay, so forward rate. It's always again you do something today. You fix a rate for something that's going to happen in the future, okay? So it's at the forward rates, again, currency rate, interest rate, and so on. So it means a forward, no cost. You don't pay a price today, but no cost. But because there is no cost, there is no flexibility. Okay, so that's about futures and forwards. Okay. Then next, we discussed the basics about options, call option, put option, buying, selling. And there the message is that the added value of options is that you can avoid to lose money, okay? But of course, if the rate is going in the right direction for you, then of course you don't exercise, and then you can increase your profit, okay? But again, that means flexibility, okay? So if it's the wrong side, you don't. If it's the wrong side, you use your option, okay? And it means you hedge your risk. If it's going in the other direction, again here no flexibility, but here you use your flexibility, and then your profit is going up. Okay, so but of course there is flexibility, but you need to pay a premium for it, and then so that's the cost. Okay, so but we come back on that in a minute. Okay? So this was 2.2, the definitions of the different building blocks in derivatives. Okay? Questions so far? Questions? Everything clear? So now let's go to C, and C in fact is very comparable to B, but now we are going to do the translation of the building blocks, okay, in currency rate risk management. So the BBs, okay, the BBs in currency rate risk management. Everything still under control. And this is covered by chapter 5 in your book. Okay? It's everything clear? Okay, so let's go to the BBs in in currency rate risk management. The structure is clear for you? So this presentation is also on Moodle, okay? There. That's the new IT in the school. So first of all, you have the financial risk circle again, and now let's have a look at the different popular derivatives in currency risk management. Okay, remember, if I ask you, tell me about not a derivative in currency rate risk management, but a traditional technique in currency rate risk management, then you're going to tell me the story of the money market hedge. Okay, so this is a list of derivatives. So let's start with now the other way around. Let's start with options. Okay, so this slide must be familiar to you, and that's what we discussed last Thursday. The basics of options, okay? But let's now do it for currencies. So let's start with at T0. So this is T0. You buy a European coal. And what was again the meaning of European? Yes, so if you exercise, it's only possible the end of the period. So buy European coal on $1. So the dollar is the underlying asset. And the exercise price, we keep it simple, is €1. So remember, it means you have the right to buy $1 for €1, okay? And the option premium it's 2 euro cents, okay? The option premium it's 2 euro cents for each dollar, but here it's just $1, okay? Okay, so that's at that's T0, okay? Now T1, okay? So this is expiration day. So again, if you, because it's a European one, so you can only exercise at T1. So T1, that's the end of the period. Again, at T1 you must decide if you exercise yes or no. So, what is the value okay, that's not completely correct. What's the total result of the option at T1, okay? Premium included, okay? To be clear. Because, again, if I ask you what's the value of the option at T1, that's something different, okay? Because, again, if you buy stocks today, and I ask you, let's say that you buy Philips today for €5, and 1 week from now it is €7, okay? So if I ask you the question, what's the value at T1, the value is 7, okay? But the result of investing in stocks Philips, of course, then you must include the fact that you paid €5 for it, okay? So there's a difference between the value of an instrument and the result, because if you want to know the result, you must include the price that you paid for it, okay, to calculate the overall result. And again, here I want to have the result, okay, at T1, so premium included, okay? Okay, so here we have the spot rate of the dollar at T1, okay? So there we have the spot rate of the dollar at T1, and here we have the plus, and here we have the minus, okay? And here we have 1. So 1 is that. So this is in. So spot rate of the dollar. So here you have €1. So here you have 98. Here you have 96. Here you have 94. 92. Here you have 1.02, here you have 1.04, 1.06 and 1.08, okay? So that are different levels, okay? So that are different levels of the spot rate of the dollar in euro, okay? So, and for your information, of course, that's not fully in line with financial management, but because again, if you buy the coal, you must pay the premium at T0, okay? If we include, if we calculate the overall result of buying that coal, we include the premium, but we are going to exclude the time value, because 2 euro cents at T0, it's not 2 euro cents at T1, okay? But we don't take, we are not going to take the time value into account. We just keep it 2 euro cents, okay? So please tell me, if, again, this is the profit, the P, and this is, if you lose money on that transaction. So, if the, again, you are the buyer, you have the right to buy $1 for 1 euro, okay? That's what you did, and for that you pay 2 euro cents. That's what you did at T0. If the spot rate is at T1 is 94 euro cents, so $1 is 94 euro cents, are you going to exercise the call? So if at T1 $1 is 94 euro cents, so that's the spot rate, are you going to exercise the call? No? Yes? No? Yes? So again, you buy the coal at T0. It means you have the right, but only at T1, because it's European, you have the right to buy $1 for 1 euro. Now we are at T1, and on the exchange, the dollar is 94 euro cents. At T1. She insists in exercising. What no? You don't exercise. No, because again, you have the right, you have the right to buy $1 for 1 euro, okay? But again, if the dollar rate here is 94 euro cents, it means that if you want to have the dollar and you buy it on the exchange, you only pay 94 euro cents, because that's the meaning of the spot rate at T1, okay? If you exercise your call, you pay $1, 1 euro for it. What do you prefer? If I ask you, I can offer you the dollar, and it's up to you to decide if you pay me 94 or 1. 94? So, conclusion? You don't exercise, okay? You agree?
Could you please repeat it, because somehow...
You also want to exercise?
If it's 0.94, then...
Again, this is the meaning here is so $1 is $1 is 94 euro cents. Okay. So again, buying a European coal with exercise price 1 euro. Again, it means at T1, that's expiration. At T1, you have the right, not the obligation. You have the right, not the obligation, to buy $1 for 1 euro, okay? But now we are at T1, and again, if you exercise the call, you pay 1 euro for the dollar. Yeah. But again, on the currency markets today, okay, the spot rate is $1 is 94 euro cents. So if you just go to that exchange and you buy a dollar on the exchange at T1, you only pay the spot rate 94 euro cents. So,
Is that it does not make sense.
so,
to
so
rise.
again, so it's going to be more expensive if you exercise the call, okay? Of course, you buy then the dollar on the exchange, okay, without exercising the call. You see the point?
And when do I have to pay this option premium? Or it's already in the value or?
No, so this is, so it's not yet in, so this is, so this, again, you buy, if you exercise, then you need to pay for each dollar 1 euro, but of course, the premium, that's something different, okay? That's what you pay at the beginning, okay? And again, if you don't exercise the call, that's it. If you exercise the call, in addition to the premium that you paid at T0, you pay then the exercise price, okay? So it's not yet included in the exercise price. So, ladies and gentlemen, it means, what is the total result at expiration day of buying a call if the spot rate is 94? No, what is the what is, just look at, so again, you decided to buy a call at T0, now we are at T1, you don't exercise, because it's cheaper to buy it at the exchange. So what is then the total result, but only from the option, as a result of the fact that you have an option in portfolio, it is? No? No? But no, again, only the option, So again, that you buy the dollar on the exchange, okay? Okay, but that's different from the option, okay? So again, you have the right to buy the dollar for 1 euro. You decide not to use that right. So, but now I'm not asking you what's then the total result, in the fact that you buy the dollar at the spot rate. No, I'm just asking you, if you decide at T1 not to use the call option, what is then the total result of the option? So you lose, so the minus, you agree? So because again, you paid at T0, you paid 2 euro cents, now you decide not to use the option, you lose the premium, okay? Again, it's the same story with an insurance, you pay the insurance premium, and then at the end of the year, okay, nothing happened, okay? So what's then the total result of the insurance for that year? Yeah, that's that you paid the premium, but there was no cash inflow from that, so then it's a negative result. How much? The premium paid, okay? So here the same, you don't use the call, so you have, again, I don't take the time value of money into account, okay? So it's, we are not for it. So it means that, and it's the same story, of course, for 92, 96, 98, okay? So in this range, so this, and so if, so call, or buying a call to be buying coal. So the first range is if the spot rate at T1, so if the spot rate at T1 is less than the exercise price, okay, so exercise price is 1, so if the spot rate at T1 is less than the exercise price, result, don't exercise, so so you're not going to exercise, you don't use the call, okay? And what's the result? Loss of premium. Okay? Is that clear to everyone? Tell me, if the spot rate at T1 is $1 is 1.01. So if the spot rate at T1 is $1 is 1.01. Are you going to exercise, yes or no?
Yes. If it's how much, sir?
Sorry?
If it's how much?
1.01. So here in the middle here.
You don't exercise. No, you don't. It's because your premium is
You don't exercise? You exercise?
I think so.
Yes. You don't exercise? Yes, no? Yes?
Yes.
Oh, now it's yes here.
Yes. Yes. You do?
If how much? If you don't exercise, you lose.
2 cents.
If you don't exercise, you lose the premium. Okay? So if you don't exercise, you lose the premium. So that's 2 cents. If you exercise again, it means you can buy. So you can buy $1 for €1. Okay, so you pay €1 for one. So this is a minus, because if you exercise, you pay €1 for the dollar. But if the spot rate is 1.01, then you can sell. So you can buy it for €1, but you can sell it for 1.01. But you also pay the premium. So if you take everything together, it's still a minus, but it's only €1 cent. And again, if you don't exercise, you lose 2 cents. Okay. So if you exercise, okay, it's still you still lose money, but less than if you don't exercise. Okay. So so this is the second range. So this is one is the exercise price, and 1.02 is the exercise price plus option premium. So why? So in this range, again in the exercise price and so if the spot rate at T1 is between the exercise price 1 here and the exercise price plus option premium 1.02, you need to exercise, so exercise, but result, you still, there is still a loss. So again, if the spot rate is between the exercise price and the exercise price plus the option premium, you need to exercise. The result is still that a loss, but less than the option premium. Okay, so €1 here, €1 and not €2. Yeah, you agree? So that's this range. Clear? And then of course, range 3, spot rate, more than exercise price plus option premium. So spot rate more than 1.02, okay. Do you need to exercise?
Yes.
So you need to exercise and results profit. Okay. You agree? So this is the red line that is buying a gold. That's buying a gold, okay? Okay. This one the green line, it means plus 2 euro cents in range 1, still a plus, but less than 2 in range 2, and losing money in range 3. So if the result for you is like the green line, you are what? The specialist? Selling a put? Selling a call? Sorry?
Buying a put.
Yeah, and so she's not selling a call, but writing a call. That's the same. No, just for your information.
Buying a
Oh, buying a put. Selling a put, buying a put.
Yeah, right.
By the
What? The future of the group is buying a put.
Which means you're selling.
buying a
Yeah, but what does it mean? She's always yes, 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 but what's the yes? Buying a put. A put. The green line. So it's of course, because remember,
or maybe
if someone again, if you have the right to buy something, okay, someone else must have the obligation to deliver. Otherwise, it's not going to work. Okay. So again, here. So if you are the buyer, if you again as buyer. As buyer, you paid as buyer, you paid 2 euro cents at T0, okay? So that's what you paid at T0. If then at T1, if at T1 the spot rate is, for instance, 94 euro cents, as a buyer, okay, you don't exercise, and then the seller who needs to deliver, if you exercise the call, again the seller can keep the premium because you paid it at T0, 2 euro cents to the seller. Again, if the spot rate is 94, again you don't exercise, and for the seller the result is he got or she got the premium and nothing is happening at expiration date. Okay, so in this range, okay, it means that the seller can keep the premium because no exercise of the call at T1. Here you are going to exercise, so it means that the seller needs to deliver you the dollar. Remember, this is the story of the buyer. But then the seller needs to deliver $1 to the buyer. If the spot rate is 1.01 and you need to deliver because the buyer is exercised the call, if you are the seller and you must deliver, you must buy the dollar. Okay, so you buy the dollar, but the dollar price is 1.01. Then you need to deliver the dollar to the buyer of the call. The buyer of the call needs to pay to the seller the exercise price. So as a seller, again, you need to buy the dollar at the spot rate. You receive the exercise price from the buyer of the call, but you also received at T0, you received the premium. Okay? So if you add up everything, you still have a profit, but less than 2 euro cents. Okay? So in this range, the profit is going down, but it's still a plus. Okay? Of course, from the moment that the spot rate is more than the exercise price and the option premium, again, for instance, if the spot rate is 1.06, again, if you need to deliver, you first need to buy it at the spot rate, 1.06. You receive, as seller, you receive the exercise price and you receive the premium. But it means that, so at 1.06, okay, again, you lose how much? You lose 4 euro cents. And of course, if it's going up to 7 and 8, your loss is always going to increase by 1 euro cent. You see? So it means that the green line conclusion is selling a goal, okay? Is that clear?
Excuse me, sir. Does buying a put means selling a call?
No. No, so now we have the red one buying a call, the green one selling a call, okay? So now, so because he's confused, because he thinks that selling a call is the same as buying a put. That's a little bit strange, so let's now, so what is, so if I tell you, you buy a European put. Exercise price 1, option premium the same. Okay, so what is the result of buying a European put? Again, if you think that it's going to be the same as the green line, okay, but is that correct? Yes or no? Again, but buying a put with this exercise price and this premium, it means that you have the right to sell the dollar, for 1 euro, okay? So you have the right to sell the dollar for €1. That's the meaning of buying a put. Okay?
And you get the premium?
No, because you buy a put, you need to pay a premium, okay? So you pay, so you pay always the 2 euro cents, and of course, if you don't exercise the put, that's it. If you exercise the put, then it means that you can sell it for, and so on, okay? And you receive then the 1 euro for your dollar, okay? So question, if the dollar at T1, if the dollar is, let's say, 1.06, the spot rate is $1, it's 1.06, are you going to exercise the put?
No.
Yes?
No.
No?
Yes.
Yes? No?
Yes.
No, you won't exercise.
No exercise?
Sure, yes.
Not sure yet.
You won't exercise, no.
No? No? And you convinced her, or she says no? Of course, if the spot rate is 1.0, it means, okay, it means if you have the dollar, you can sell it on the exchange for 1.06 euro, okay? If you have the dollar, but you exercise the put, then you receive so then you only receive 1 euro. So if I ask you, what do you prefer at T1? What do you prefer to receive 1 euro for the dollar or 1.06? I think it's better to go for 1. Okay? So it means you don't use the put. Okay. So but you pay again. You paid the premium. So total result is, but only from the put. The total result is that you lose the premium because again you paid for the put and you don't use it. Okay, so you paid. So this is the. Okay. So the first range. So this is. So buying a put. So the first, the spot rate at T1, so the spot rate at T1 is now not less than the exercise price, but more than the exercise price. Don't exercise, and the result is loss of premium. Okay? Clear to everyone? So spot rate T1 more than the exercise price. Don't exercise, and the result is the loss of premium. What's now the second range? The second range for the call is exercise price and exercise price plus option premium. For here for the put, if for instance if the spot rate is 0.99, if the spot rate is 0.99, are you going to exercise the put? Yes or no? Yes, because again, if you don't exercise, you lose 2 euro cents. And by exercising, you still lose money, but only 1 euro cents. So the second range here, it is not exercise price and exercise price plus option premium, but if it's a put, the second range is exercise price minus option premium and the exercise price, okay? So, exercise price minus the option premium. So, in the second range, exercise, you need to exercise, and the result is still a loss, but less than the option premium, okay? So this is the second part, okay? And of course, then you have, if the spot rate is less than the exercise price minus the option premium, then the conclusion is you need to exercise and the result is a profit, okay? And that is this part of the story. So this is buying a put. Did I convince you that buying put and selling a call is not the same? Okay? And then, of course, very difficult question. I don't have another color, so I do it. So let's do it like this. That one is? Are you sure? Of course, that's the opposite of buying a put. It must be the seller of the put. Okay? If you don't exercise the put, okay, of course the seller can keep the premium here. Still a plus, but less than the premium, and here of course it goes down and the seller is going to lose money. Okay? So what's the conclusion about? So again, these are the four possible basic strategies. Okay, basic strategies. Again, at expiration. So that's so if you compare. Mickey Mouse is there. So if you compare risk to return, what's your conclusion? Risk return, if you buy options, it's not different for calls and puts, it's the same. So if you buy options, what about your risk? Your risk is, so your risk is limited, because again, you can never, if you buy, the maximum that you can lose is the premium. Okay, so you can never, if you buy options, again, you can never lose more than the premium. So the risk is limited, but the return is. So, okay, Because again, of course, for the, so it's not completely correct because it can never be less than 0, but again, if the spot rate, if the sky is the limit, your profit is also going to the sky, okay? So no limit to the profit, to the return, okay? So, but if you buy, and again, it's the same story for call options and put options, the risk is limited, the return is unlimited, okay? But, small big problem, if you sell options, then the risk is unlimited, okay? Again, if the spot rate is going up, you always lose more, okay? So, selling, unlimited risk, and what about the return? So it's limited because again, as seller, the maximum return is that you can keep the premium, okay? It can never be more than the premium. It can only go down. Here, because seller, what's the max? Again, the plus, never more than this. And the same if you sell a call. You never get more than 2 euro cents, okay? The same for an insurance, okay? I pay insurance premium. If nothing is happening, they don't need insurance company is not going to pay to me. So what is then they can keep the full premium. But from the moment that they need to compensate me for damage, okay, it goes down, okay? An insurance company can never earn more than the premium, okay? Okay, so you agree? You agree? So now, question, because starting from this, because this is nothing else than overview of the result of the 4 basic strategies, okay? Using options. Now we are, for this moment, of course, very simple questions. If you, now you are not an hedger, but you are a trader. So you just want to make money by taking a risk. Again, I think it's very simple. So if you expect, so you are a trader. So, if you expect that the dollar rate is going up, going to 2 euros or something like that, and again you are a trader and you expect that the dollar rate is going up to 2, 3 and so on, and you want to make profit, what?
Dollar.
Yeah, but now again we are, so you are,
Yeah, okay.
you're an option trader, okay? You work with options. So if you expect the dollar to go up, you buy a call, okay? So for your information, what is, it's never correct. Some people, if there is a question, the answer is it's a call or it's a put. That's never correct, okay? You always need to tell me if you buy or if you sell a call or a put, okay? Just putting there a call or a put, it's not correct. It's always buying or selling, and that's the same. Just buying is also not correct. Do you buy a call or do you buy a put, okay? So, if you expect and you buy a call, okay? Of course, if you expect that the dollar rate is going down,
If it's going down, yeah, it's like you said.
very bad traders in the room.
You don't do anything.
If you expect that the dollar rate is going down,
You don't do anything.
you
Buy a
you buy a put, okay? Because if you, what was your first answer? Selling a put is that's a dangerous trade, because if it's going down, okay,
Keep using.
again, if it's going down a little bit, you can still keep the premium. But if it goes down, okay, you lose money, and maybe that's the end of your trading desk. Okay, so very dangerous person. Okay, so so in other words, you buy a put. Okay. But now, clear? But what's now the problem? So, you have no view, so you don't know it, so you have no view about the dollar to go up or to go down. You don't know it, okay? You don't know if it's going up or going down. The only thing that you know is you expect high volatility in the market, okay? Big changes. That's the only thing that you know, but you don't know big changes up or big changes down. You don't know that. Only thing that you know is high volatility, big changes in the market, but you don't know up or down. So if you are a trader and you want to make money with this view, again you have no view about increasing or decreasing rates, only view is big volatility, high volatility in the market. How can you make money with that view? What do you need to do to make profits?
You buy both.
Because again, if you buy a put, and again high volatility, it means or that direction or that direction. If the high volatility means this direction, you make money with buying a put. Okay?
And it's, lose the premium on the other one only.
Yeah, but again, if you don't know if it's going up or going down, so if you want to make money with high volatility, you must also try to make money if it's going that direction. And how do you make money if we are here at the end of the period buying a call? So you buy a put. You buy a put and you buy a call, okay? And what's the name? What's the name for this strategy? If you buy a call and you buy a put, again with the same exercise price and of course the same underlying asset, the name for this strategy, buying a put and buying a call, what's the name for that? No, speculation. It's just a different name for trading. It means I try to make profit by taking risk. So this is all speculation. Okay. This is no, it's all too general. No, because what's the meaning? What's the meaning of arbitrage?
Trying to make money from.
No? Well, again, what's the meaning? You have hedging, you have trading, and you have arbitrage. What is the... Again, hedging. Again, it means I don't want to make profit. I want to create certainty, okay? So that I can sleep well, no risks. That's the meaning. That's the meaning of hedging. Okay. Trading or speculation. Trading. It means I try to make profit by taking risk. Okay. Because again, if you expect the dollar rate to go up, okay. Again, you buy a coal, and if it's going in this direction, you make money. But again, if it's not going in that direction, you lose money because you lose the premium. Okay? So you try to make profit by taking risk. That's trading. And what is arbitrage? Arbitrage is that you try to make profit without taking risks. Okay? So you try to make a profit without, so you try to make a risk-free profit. Remember, so you, again, risk-free profit, it means you try to get a free lunch, okay? So arbitrage opportunities are only possible if markets are not efficient, okay? Because normally in efficient markets, you cannot make profit if you don't take risk. But again, that efficiency, it's nice to discuss at the university and so on, but if you believe that in reality markets are efficient, okay, you are very naive. Okay? So in other words, markets are not efficient, so they are sometimes inefficient. And why can you make risk-free profits? Okay, that is because there are inefficiencies. Okay? So in the good old days, now of course it's a little bit different. But what was a very simple arbitrage opportunity in the time that there was not yet IT and so on, and trade platforms, so it was very simple. For instance, it was possible to buy Philips at the Brussels exchange. Okay? Now of course it's one IT system, but in the good old days it was only telephone. Okay? So the price in Brussels of Philips was not always the same as in Amsterdam. So that was then, that was place arbitrage. So if you are aware, okay, of what is now the price of Philips in Amsterdam, what was possible to buy it in Brussels and then immediately sell it in Amsterdam, okay? Because it was sometimes a little bit, of course, not the difference is not 20 euro, but it was a little bit cheaper in Brussels or the other way around, and then you buy it in Brussels and you sell it immediately in Amsterdam. No risk, okay, because you do the trade at the same moment, because you know the price in Brussels and the price in Amsterdam, but you make money because of an inefficiency. Okay? But of course now it's a different story, but that was 30, 40 years ago, a simple way to make money. And that's arbitrage, because you are fully hedged, okay, because you buy and sell at the same moment, and you know already that there is a small difference that you make a profit. That's arbitrage.
Are there still any area where we can earn this arbitrage?
Sorry?
Are there still any possibility to earn arbitrage nowadays or not?
Yes, but of course not just by simple buying in Brussels and selling in Amsterdam, but that's the reason all those hedge funds, they are very much investing in people with, who are very sophisticated, okay, in calculating prices and so on, because what you can try to do is, but of course that's advanced finance, that is, for instance, even if you keep it simple, you can prove that buying a coal, it's the same as buying a fraction of the underlying asset together with borrowing or lending the money. Okay, so that's so you can again an alternative for buying a coal is buying the underlying asset together with borrowing or lending. Okay, so it means that if you buy a coal and you do then, you know, buying a coal is the same as buying the underlying asset and borrowing money. If you buy the coal and you do the opposite, okay, so you don't buy the underlying asset but you sell it, and you don't borrow but you lend, then you have a hedge portfolio. And if those prices are not in line, okay, then you can still make an arbitrage opportunity. But even that's too simple. But you have very clever boys, okay, in rooms in banks, and they try to make very complicated combinations. So if I buy a call with that exercise price and I combine it with a bond and so on, that portfolio is the same as another portfolio, but then with different instruments. And again, in an efficient market, all those prices, they need to be in line, okay? And if all the prices of all those different instruments are in line with each other, then you cannot make an arbitrage profit. But again, in the market, not especially for complicated instruments, not all those prices are in line, okay? And it means that by doing a clever combination today, you can make a portfolio so that you are fully hedged at the moment that you liquidate the portfolio, but because of the fact that the prices at the different exchanges and so on are not in line, okay, by building up this portfolio, you can make money, and you can prove that at the moment of, because making money by building a portfolio, that's not easy. Oh, that's not difficult. Because I can make money by making a portfolio today, but then if I look to the future, I can lose it again, okay? And that's not an arbitrage profit. An arbitrage profit is I make a portfolio, based on making that portfolio, I make money, and I can prove that the money that I make today, that I cannot lose that at the moment that I liquidate the portfolio. That's an arbitrage, but that's coming from inefficient markets and very complicated, okay, combinations of that instrument together with that other is equal to, and so on.
So is this what investment banks in the US try to do?
Yeah. So that is and was the basic principle behind a hedge fund. Now again, I told you already, a hedge fund now today is not always a hedge fund anymore, because they take open positions, and the money that they can make today, it's possible that they can lose it at the end. So that's not a hedge portfolio, a hedge fund. But the start of the hedge, the basic idea behind hedge funds, that is trying to make money without taking risks. LTCM and so on with Myron Scholes, at the start of the LTCM, it was based on making profits without taking risk. So that's the main principle. So if it's a real hedge fund, okay, it's a fund that tries to make money by being hedged, okay. We don't take risk, but we still make money at the moment that we build the portfolios. That's the objective if it's really a hedge fund. Okay, so yes, what's the name?
Mixed options.
Mixed options, yes, but so this is buying this is buying a straddle, okay? So you said, or long, long straddle, okay, and buying a straddle. So if you buy a call and if you buy a put, again, it's just to show you that it's not difficult to impress people, okay? If I tell you about buying straddles and so on, you are impressed. Not yet, I need to find something else to impress her. But again, a straddle, it's nothing else than two basic strategies, buying put and buying call. If you put this, if you buy a straddle, what's the result here? Again, if you buy that European call, with all, and you buy, what's the result over there? So sure, just put it on. So if you buy, what is at T1 at expiration day? What is the result of buying a straddle? And again, it means that you buy a put and you buy this call. At this point, we have. How much do we have here if it's buying a straddle? Oh, where do I, no, here, where do I need to go? Huh? If the exercise price at T1 is 1, and if I, again, what did, so at T0, I did the combination by, oh shit, this is not good. Ooh la la. Oh, that's 2 times wrong. So that's always the, I always tell them, don't put permanent markers, and that's the result. So, problem solved. Yes. Okay, now I have a problem. Now we are going to put on the evaluation. We are not impressed by his lectures, but by his cleaning. Okay, so again, what are you doing at T0? You buy European puts with this exercise price and this premium, and at the same plus you buy a European coal, same exercise price and same premium. Okay. How does it look like at T1? So at the exercise price, we have, if the spot rate is 1,1 at T1, and again that's what you did at T0, then the total result of that strategy at 0.04. Yes, because again, you here, you don't exercise the call, and you don't exercise the put. But you paid 2 times, okay? So it means you lose 2 times the premium. So you are at 0.04, okay? Because again, at the exercise price, you don't exercise the call, but you paid again, and for the call and for the put, you paid 2 euro cents, okay? So, tell me, if the spot rate, again at 1, we lose 4 euro cents. If the spot rate is 96, again, we have the combination of the 2. If the spot rate is 96, we have 0, 0.04 again, and there, nothing. 4, nothing. Break even, yeah, but he doesn't agree with you, that's the problem.
Can you say the question again, please?
So again, if we do at T0 buy European, then again, if it's 1,1, we are at 4 euro cents minus, okay? Now we are not at 1, but at 96. What's then, if the spot rate is 96, what is at T1 the result of buying a straddle at T0? It's break even because again, we buy a European put, and with the puts, okay, with buying a put, we are, or with buy, let's first take buying a call. With buying a call, you are with the call, you are at 2 euro cents minus. But this is the put, buying a put, and here at 96, so at 98 it's 0, okay? And then from this moment on, we make a profit, and at 96, with the put, I make 2 euro cents profit, okay? So I lose 2 with the call, I make a profit 2 with the put, the 2 together is 0, okay? So, and here the same story, but at 1.04, again with the put, I lose 2 euro cents. Here, with the call, I make a profit of 2 euro cents. So again, conclusion, this is buying a straddle. Okay? So buying a straddle, it's going like this, but it's nothing else. So if you combine the red line, buying a call, with the black one, this one, buying a put, if you combine them, you end up with buying a straddle. Okay? You see? Again, it's just to show you that if you want, we can now start a lecture for another 4 hours with option strategies. Okay? But again, that's not, and that's more portfolio management. We are not going to do that. Okay? But I can impress you with straddles and butterflies and strangles and so on. But at the end of the day, if they use difficult names, just ask them, please tell me which basic strategies are there included in your strange name. Okay? Because again, it's always based on just simple buying, selling, call, put options. Okay? That's it. And they just give a difficult name, so that's the reason why bankers are making so much money. They just give strange names to instruments, and then everyone thinks that they are very clever boys and girls, okay? And that they need to get a big bonus. Especially in Hungary and so. Is this clear? So again, don't worry too much about the straddle, just to show you that from here on, okay, we can go on for hours and a whole list of strange names, okay?
Can you have a break?
President is taking your job. You are really a president. Huh? Okay, that's, how long? 15? What's normally the break in Vietnam?
40 minutes.
Don't take the DSM break, otherwise we are not back before evening. Yeah?
Your last lecture for this course is
Me parece que engañan con el precio, ¿sabes? Porque si no uno podría, claro, pero no me falta